I don't see any. I don't see anyone's face. I'm probably not going to be reacting the way I normally do, which could be a blessing. All right. If you're not familiar, very quickly, we're going to go through the CFTC report, make an assessment of it, if it's going to help us for Sunday night as well as next week, and get an idea of who's making and who's losing money. CFTC reports are, generally speaking, evolving. They may be less helpful than they have been in the past. So let's just go right into it. Market dominance has been changing. We've become a real market now, not dominated by swap dealers, at least not lately. You guys have seen all, my opinions on that shit before. All right. Here we go. I haven't done any of my writing yet, as you can guess. You can probably guess why. One, two, wait, I only have 4 days there. Did I miss a day?
I think the holiday was in there, no?
16.
Yeah, it was Good Friday. We closed early, didn't we?
Yep.
Okay, good. So my rectangle is in the right spots, right? Yes, no, maybe.
Yeah.
Tuesday, Monday,
Yeah, it should be 4 for the first week.
Thursday, Wednesday.
All right, hold on. Let's make sure.
Yes. Yeah. Because the 2 flat days that you have there, the alternating red and green, right, that are sitting on top of the letter D.
These two?
Yeah.
Oh, there's your Good Friday.
That's
No.
Tuesday. The green one is Tuesday.
I missed the little green one, right? Right. All right. So I missed the little. Did I miss the little green one? Wait, no, it shouldn't start on Tuesday. It should start on Wednesday.
Correct.
Wednesday, Thursday, Friday. Oh, there you go. Friday's in here. Right. So it's Good Friday. So we're good. Wednesday's the first day. Thursday, Friday, and Monday are together. Tuesday, and then these last 3 days. Okay, good. All right. So I'm okay. So what do we have? It's actually pretty easy. Not incredibly easy, but pretty easy. And let me guess. Yeah, see this day here? Here's your inverted fishhook. Here it is. There's the long wick. The market closes down. The open interest is flat. That means new longs bought from old longs. Fucking market rolls over. There's your upside down fishhook. And boom, lower. But, it's hindsight. Let's see if we can see the next one. All right. So we've got 5 days. Let's see if I can I'll start recording now. Oh wait, I am recording. Okay, here we go. Where's my drawing tool? Hang in there. Oh, there it is. I shrunk it by accident. Hang on. Oh, I see. It's not showing because of this. Damn it. I'm using too much of the screen. Keep losing. Fine. I'm losing the drawing tool. Fine. We're just gonna have to deal with that. I'll survive. All right. You see my screen, you hear my voice, and we're getting ready to go. Here we go. All right, so we've got 5 days. It's an up week. Forget about all the nuances. It's an up week. It's not a trend week higher. It's a normal variation, which means nothing to you unless you're familiar with Stottlemyre, but it just implies that you didn't have just one way order flow. All right, so here we go. Day 1, we've got up 6,800 contracts on a big up day. Day 2, 4,900 contracts. So long sold. And then shorts, long sold and then shorts covered. Interesting. Okay, not sure what happened here. Third day, 7,700 contracts, another up day. Well, that's really right. Third day is the combination of 2 days. And the last day is the day that matters. Always the day that matters. Long wicks that are red always matter above the market. All right, so we've got 974 contracts on that day. This day is basically the market opens, goes higher as FOMO smaller funds get in, and then they get sold by older longs or bullion banks. In a normal market, this is bullion banks selling ahead of producers and old funds getting out. Paul Tudor Jones sells, bullion banks sells, and Paul Tudor Jones is what we use as an example of a macro discretionary. Paul Tudor, bullion banks, and producers all are stacking up to sell. But lately, I'm going to say it's probably not bullion banks selling up there. It's probably funds. Scott, I'll never forget that you called that. It's a great move. Bullion banks not selling, macro funds selling, and who knows? Maybe the BIS is getting involved. Probably not. They're probably buying now. And the market turns and it gets partially ugly in anticipation of bigly ugly. Last 3 days. Down day with no bounce. Up day from the lows. Down day with a big bounce. By the way, if you guys remember, I talked about this before and I put it in one of the posts. Around 2:30 on this day here, I saw the red, the green, and the red. I saw these 3 candles bottoming in here, and I put these 2 alerts here. Below here, I want to get bearish. Below there, I should definitely be bearish. You may remember, like going back about a year and a half, I was like, oh, this should, if it breaks here, we're going down. If it breaks here, we're going down, and never broke there. So I'm not calling it yet. But I'm saying this buyer, this was not this. The point is, this was not a level, and now it's a level. You know, there's a level being formed by someone saying they want to buy. In the past, I would have said to you, it's a central bank. In the past, I would have said to you, it's macro discretionary, bigger than I know, or maybe even China. But what I would not have said is, it's a bullion bank, and maybe it's a bullion bank. You know, maybe they're involved in this mix too. I'm going to open the chat up. So open everything up here a little bit so I can see you guys. Close the chat. I'm going to close the chat, open the pictures. Do you want to say something
I'm
about
on.
talking about?
Never mind.
Oh, why do I have double pictures of everyone here? Oh, gallery. That's what I need. There we go. Gallery. Perfect. All right, good. All right. Better than what we were. For me, anyway. Okay, so I'm giving you the bullish scenario. See these 3 things here? I'm going to say what I said last year. I'm going to say, oh, there's people that are still trying to get in. If we don't get below here, we're going back up in a rush. But I'm not predicting we won't go below there. Okay, so last 3 days, we've got red, green, red. We've got down, we've got up, we've got down and then up. So we've got 6,600 contracts get out. 12,000 contracts get out. Oh, there's your bullion banks, boys. That's your bullion banks. And nothing happens. Okay. So I'm going to mute as I clear my nose here. All right. So what do you got? We have a market that does the following. This is great. All right. Market runs up. I haven't looked at the breakdown of the open interest and who does what yet. Okay. Market goes up. Funds getting in on day 1. Does that erase? That should erase. Fuck. Now it won't go away. God damn it. All right. Anyway, funds getting in. As I said, I don't know what happened here, but 4,900 contracts got out. I mean, it's negative and 4,900 contracts got out. So you would say 5,000 contracts got out. You would say by the rule, you would say the market is lower, longs puked, right? The market is lower, open interest came in, longs puked. However, the market is lower, started much lower, finished, well, went much lower, finished almost unchanged. So you could say the market started with longs getting out and then shorts covered. This day, another traditional day, that's a trend day higher. 7,700 contracts get in, and then this day, which is your inverted fishhook starting. All right. So here we go. Here's the story. Funds getting in, funds getting out, banks buying, funds selling, banks buying. Maybe. All right. Funds buying. Funds buying, funds selling. Market goes negative, maybe some banks buying. Next day, market goes lower. Funds selling. Open interest down. Funds selling. The direction is lower. And here's the day that we like to see. That is bullion banks buying. Because the buying comes in here. And we could say 100% that is shorts initiating to buy. So a short stopped it from going lower here, came back again tomorrow, and then the market ran away from it on the last day. These last 3 days is all one big short. I mean, it could be multiple shorts, but it's one big cohort of shorts. All right. Any comments or questions on that? I'm gonna.
Yeah, are they right?
Well, if they're covering shorts after the market comes off, they're right to make profits. Okay? That sounds like a cheeky answer, but it's not. If it's the bullion banks, I'll tell you what it is. Bullion banks are buying on the way down here. And so because they're so much shorter than they used to be, they used to buy on the way down and then let it breathe. Buy on the way down, let it breathe. Now they're buying on the way down. And when it runs into a wall, I'm going to say they're right to answer your question directly. They're buying on the way down. I bought some, I bought some, I bought some, I bought some, I bought some. And for some reason, it didn't go below here, and they're not letting it breathe. Now, they're much less apt to let it breathe nowadays because they're so short, but I can say I can handicap this. They still see the buying. They see the buying now, okay? They used to see the selling. They see the buying. Someone's buying down here. Central bank, macro fund, who knows? But they're buying in front of it. So are they right? Yeah, because if they're buying here, they probably have buying right underneath here. So I do believe that bullion banks, even though they're covering, are giving us an idea of what's going on. It would be nice, just like the old days, guys. It would be nice to be able to be on a desk I used to be and see this and see the bullion banks selling. I knew that was the top, right? They had selling above. Now they're buying. They're covering shorts, but they're buying because they have buying below. They're not letting it breathe because they have the buying. All right. So to answer your question, I was going to be bearish below here and short below there. I still am. But now I'm on alert below here and bearish below here because usually their buying is right above whoever bought last time in this area. So technically it comes out very clean. It's like they're buying here, which is not a level. It was not a level, but this was a level. So my guess is their front running buying that they see is here. So the play is, Jim, it was bearish short. Me now it's alarm bearish short. That's how I'm going to look at it. Because this may be profitable to be bearish if it goes down here, but it may be a grind. And I don't want a grind. I want something quick. Okay? Now, classic technicals would tell you that right now this is a bear flag. Right? Down. And if it cracks say you draw a trend line in here, you get bearish, and that might be a good play, but I'm not going to sell it there, right? I'm not going to do that right now. So am I bullish now? Well, I'll tell you, you should be nothing right now. Below here, you're on alert to be bearish. See this here, this little double top area here? The day, this is actually important if you're bullish. It topped here and closed here. The next day, it opened here, retested that top, and backed off. Or it opened here, opened here, retested that top, backed off, and rallied. So this day is actually very good for giving you levels. Meaning, if it gets above here, I might get bullish. If it gets above here, I'm definitely bullish. If it gets below here, that might be your bear flag selling down. So it's kind of like, as long as we're inside this candle, this body of this candle, I don't give a shit. Above that, I'm bullish. And below that, maybe I'm going to be bearish. So that's it. That's my answer. Okay, let's move on to the next chart. For some reason, this thing won't let me stop drawing. Trying to stop drawing now, and it won't let me. I'm trying to get out of it. It won't let me get out of it. If you look at a weekly, yeah, it won't let me. Stuck drawing. All right, I'm going to pause. I'm going to stop the share. I think my computer's freezing up a little bit again. All right. Yeah, stopping the share allows me to get my cursor back. All right. And share again. Yeah, that cleaned it up. All right, good. Perfect. Back to normal. Back to normal. Okay, let's go to the actual CFTC report. While I'm looking at the chat. You guys can look at that. I'm going to read the chat for a second. So Wednesday, Thursday, Friday is shorts covering their short-term purchases from previous. So Wednesday, Thursday, Friday is shorts covering their short-term sales from previous Tuesday, Thursday, Tuesday. Is that what you're saying, Iggy? Leon, if you look at the weekly candle on gold, large range, doji closing on bottom of range, typically signals danger. Will Robinson, danger. Large range, doji closing at bottom of range. Yeah, Leon. I don't disagree with that. I don't disagree with that, but the long wicks, Leon, you're talking about that last day, right? Weekly. Okay, yeah, let me pull up the weekly. That's right.
It's like a wick. The weekly is a wick with, or the wick is more than 50% of the body. So I think that's a bearish.
Yeah, it's
signal.
ridiculously ugly. That's a lightsaber. I call it a lightsaber. Yeah, it's ridiculously bearish. The next week could be the next candle. I think it has to be a bearish engulfing, becomes like an evening star or a shooting star. I just call it a lightsaber. It's horrible. Yeah, so this is bad. It's bearish. It's not bullish. right? It's not bullish. It's definitely bearish. So if you combine my levels with these things here, so here's your bullish scenario. You should be long, if you want to play this game, above 32.82. That's the number I made up because that's where the buying is. And you want to be short below 32.43. And those are big numbers to use because you're measuring a weekly thing. So if you want to use my daily levels on a weekly, you would look at this. You would say a trade during the week below 32.43, I get short. A settlement on a weekly basis below 32.82, I get short. Anything in between, I do nothing. Okay? That's how you use those two levels on a weekly. You kind of invert them. You say, if it trades this low during the week, I sell it. If it settles this low in the week, I sell it. And I'm not being bearish, although I can be bearish. I sold call spreads again. Let's put it that way. All right, so Iggy, no short-term traders shorts getting out of their brand new positions or bigger bags. Yeah, I get it. So Iggy, it's probably both. It's probably both, right? Right? Because macro, I wouldn't even call it. I mean, I haven't looked at that. I swear, I wouldn't even say that smaller. I mean, there's short-term or CTA shorts versus macro discretionary. Macro discretionary is now making enough money being short to play short once in a while, and in fact, if you see macro discretionary selling into the rally, that's the same thing as being short for them. So macro discretionary, I think this is the top. So I start selling into it, right? That's what's been happening for the last 3 weeks, three months maybe. And as the macro discretionary is saying to sell it to the top, that's because there's signal saying it's no longer bullish. Those same macro discretionary or guys that behave similarly to them are going to say, oh, I might get short here. So Iggy, the sellers who covered in those 3 days could be smaller funds covering shorts, doubtful, because smaller funds don't catch the knife and then buy it on one day to just get more contracts. Shorter funds just scale in or sell it as it goes down, right? So these are big boys buying. So either it's macro discretionary saying, I bought some and I'm going to buy more to get my contracts. See, if it was macro discretionary, they would have bought some, and stopped buying. But someone who has too many contracts on and is mandated to reduce their risk goes like this: buy. I'm not getting any more. It's running away. Fucking buy it. I bought another 10,000 contracts. I raised my purchase average price to a higher level, but I'm out of the risk. So I'm leaning towards it being a healthy mix of bullion bank types and macro discretionary. So that's my answer. I don't think it's short-term traders, although of course they're involved in the mix. Hopefully that helps. Right, Leon, I got you. Thank you. Who was that? Britt who sussed that out for me what he was talking about? All right, so back to the daily. All right, so here we go. I'll make this bigger. So here's what I did do. I just got done this. Red means you reduced, green means you added. It does not mean long or short. It just means reduced or added. So on the week, on a much higher week, that was not a trend week, so it kind of reversed near the end. On a much higher week, longs added, on the producer side, with the commercial side, and shorts added, wow, on the fund side. All right, so keeping it simple, we are watching the same behavior. Long funds sell into strength. Good. Long funds sell into strength. The big long funds sell into strength. Swap dealers cover shorts, and there you fucking have it. There you go. The market was higher. Swap dealers initiated. and funds sold to them. Funds sold to them. And that same mentality of funds that are taking profits also spurs funds selling. Macro discretionary funds are playing both sides now. There it is. Some of them are getting out of longs. Some of them are getting short or adding to shorts. Okay, so another bullion bank instigated short covering rally. Wow. So the bullion banks, it's kind of funny. Scott, are you here?
Yeah, I am. I was just actually typing to you.
You're
I
what?
was,
What?
I was just typing to you. Sorry.
Oh, cool, cool. So
Yeah.
that's right. Keep typing. I'm just thinking out loud here. The market was, again, funds determine direction, banks determine magnitude. If the market were to fully flip and the banks were to still be short, banks determine direction and funds determine magnitude is how we've been looking at it. And it's not wrong. But you could also say it's flipped on one side versus the other, meaning banks determine magnitude on the downside now more than the up. No. But you see what I'm getting at, right? It's like the whole model.
I think what you're saying is, and actually what I was typing to you is related to the same thing to an extent. Is that looks like quite a big add for the banks on the long side versus how much they historically add.
Oh, yeah. Actually, yeah, that's right. This is
It's not just the covering. And the idea we've discussed before about the covering is that they almost don't want it to go any lower. So it's asymmetric because the bid below wants to be delivered to. So it's almost like they had to get it higher to entice the funds to sell to them.
Right. That's interesting. That's pretty devious. Right.
Well, we had this chat a while ago. Yeah. Anyway.
No, but it's good because it's like just to spin on what you're saying right now. I just want to just translate it for everyone else. It's almost like the funds. I'm sorry. It's almost like the banks need to buy it above the guys that are bidding below because the funds need to cover before the guys below take delivery. Right? Is that kind of what you're implying?
Yeah. I mean,
yeah.
To me, the funds thought they were selling to guys who buy on margin, not selling to guys who want to take delivery, right?
Right. That's true. That's true.
They were selling they didn't realize the contract they were actually selling.
That's true. All right. So let me just, here's a new narrative based on this information and conversation I've been having about it. First of all, everyone who's paying attention, here's like information. Here's alpha for you if you're looking at these things. This is a short, over the last 3 to 6 months, we've been seeing short covering rallies instigated by the bullion banks, which have made us cheer because they're losing money. And we've seen the macro discretionary boys, they're here and here, but mostly here right now. They've been taking profits as the banks have been selling. And one of the arguments that I made is this is dangerous for the COMEX. And it is. I'm not fucking around. It is. Like this doesn't take away from that. But without using Scott's conspiracy comment, which is actually not a conspiracy, what's different empirically and viewably is this. In the past, this is true, Scott. In the past, when the funds took profits in a rally, the long swap dealers took profits. They behaved like speculative funds selling into strength. They were small as a percentage of this volume as well. So, for example, 14,700 covering. Let's say this was a down move, old gold, down move. Banks get to cover their shorts lower. And these guys would either sell or buy, depending on where we were in the cycle, but they would not have this kind of volume. We're looking at almost 60%, 55% of this volume is here. So this would be consistent, without even getting into the conspiracy yet. This is consistent with bullion bank swap dealers on the long side, assuming they're agnostic and they're making markets. So for example, the short swap dealer has the producer as his customer. This is how it works in the world. And he front runs the producer and gets short. And when the market drops, he covers. The long swap dealer has the buyer, the end user, the fund, the central bank. So these are two separate banks. One has a producer, the other has a central bank for a customer. The central banks haven't done shit for decades. These guys have dominated. Now, again, we're still not conspiring yet. The dominance within the banking industry, within the swap desk industry, is shifting from these guys to these guys. Why? Because either they're just speccing and they're smart, or they have buy orders. Okay? So the dominance, to your point, Scott, to your who's in control now? Well, the funds are capping the rallies. And I'm still looking at these guys within the cohort of swap dealers as being dominant. We're having a shifting dominance from here to here. So the swap dealers, if the market stays in its current behavior, will remain eventually back at bank swap dealers being in control of the magnitude of the market. But it's going from one side to the other. So let me restate my comment about the sell-off, Iggy and Leon as well. The market's dropping. You ready, Scott? Tell me if this makes sense. The market's dropping, and the swap dealers. Oh shit! It could be either one. Oh Jesus! This is the point. It gets a lot harder to do this. You see this here? See this run up here? These days? Who was buying? Who was buying? We know who is selling. It was the funds that were selling, right? But who is buying? I keep saying it's the short banks covering. It could be the long banks buying. Scott, you follow? And on the way down, it's the short banks covering. So collectively, the banks are buying and selling. You follow? This is the swap dealing banks buying ahead of their order flow that's taking delivery. This is the swap dealing banks covering shorts in the rally. And then taken together, they're just making the market higher. To your point about the conspiracy aspect, where it's like, okay, it's not going to go much slower. We better cover our shorts here. So whoever keeps this data, do you have a comment section that tracks what we deduce, conclude? I don't know.
Another coincidence. If you take a look, go back on the chart a little bit and look at the percentage decline, April 3rd, 4th, and 7th, it's almost to within a couple of tenths of a percent of the same decline on the 22nd and 23rd. So maybe someone's looking at that and saying, 6.5%, I'm in. And they're just not letting it go down anymore.
Let me see. What'd you say, April 2nd?
The 3rd, the 4th, and the 7th. If you do, your trading view has a thing where you could actually do like a price range, just
right.
like you have for date range, time range.
Right.
It's that number is within 0.1% of the same decline as what we just saw this past week, the 22nd.
Okay. Right. So I don't know how to find that on this tool yet. But let me. There we go. That's better. All right. So you're saying that this decline as a percentage is within 1/10 of, say, this decline, right?
From the very top of the high, not the body. Yes, the entire candle.
Right. So this to this there's a big parallel there. Right. Right. So whatever the conclusion, who's doing it or why they're doing it or what they're doing, we know that somebody is buying it here. And you know what? That would argue for a stair-step buyer. That would argue for the swap banks, the swap desk banks to be buying with or on behalf of their clients. Anyway.
Hey, Vince.
Yeah, Jim.
Sorry. Speaking of patterns, I posted something in one of your comments section on Goldfix, but you may not have seen it. There may be a pattern emerging. The last week of February and the last week of March, both weeks traded almost fully lower. We saw this pattern. This is only the third week of April, but it's doing the exact same thing. Now, that may be because we had such a high, but I would anticipate, I've got a graphic here. If you give me a second, I'll send it to you. But there may be a pattern forming, is what I'm trying to say.
Okay.
Yeah.
Oh, you look for it. I'm going to show what you give me. Okay. So
yeah.
Give me a second. While you're looking for that, I want to pull up the 4-hour chart. So you're basically saying on the 4-hour chart, it's easier to see that. It's like this to this versus that to that, right? That's what you guys are saying?
Yeah, that it's not within a couple of tenths of a percent. I think the end of the month selling has to do with, the people who are taking deliverables or whatever, or rolling over.
Well, actually, the comment I made the other week was that there was definitely a short attempt here, and the short attempt was here. Market rally afterwards, they sold, they dressed the window, and then the beginning of the month started. So this is not a short. This is not a delivery thing, but there was a delivery that was taken here, tried to take here, that got stopped, and then the market rallied. So yeah, these are all things are related, and I can't give anything conclusive now. You can see what's happening. All the guys have been here for years. You can see what's happening. The market's become a real market, and it becomes more important to not focus on my narratives and more important to focus on the empirical data. So an example of the empirical data will be, hey, what the fuck? Look at this. Is there a relationship there? There could be. Yeah, Iggy, that's the concept. That's what I'm getting at. So for example, the stair step concept that I described, I'm a central bank and I'm a buyer here. I'm a buyer of, this is classic stuff. I'm a buyer 5% below the current price. Or call me when the market drops 1%, right? Market drops 1%, you call them, they say buy. Insurance company buyers would be examples of that. Yeah, it would be. So where's the market? I want to buy a little bit tactically cheaper than everyone else. And the reason that price matters to them is because they have orders on their books. I'm going to do $1 billion or whatever renminbi in a gold product, and if the market prices drops here 1% lower, then I can lock in and make a lot more money. So that's basically it. So if, for example, he's got the market's here, and then it runs up to here, and then they get their China buying here, and then the market runs away because everyone's buying in front of the China buying, and then they raise their bid to here. They raise their bid to here, they get some, market runs away, and they keep their bid there. So that's look, whenever there's, what's the word I'm looking for? whenever there's captured methodical buying or selling, but buying is easier for me to say. Whenever there's captured methodical buying, you get things like that. I'm a central bank. I'm not going to deal with this bullshit. Call me 2% lower, right? 2% lower, but buy me, a billion ounces, 2% lower. And then the order never gets filled, or it gets only a little bit, and the market runs away and they have to chase it. So it's kind of like the bullion bank longs, bullion bank long trader is going like this. I'm going to make them chase it up to infinity because they're front running it, which is the same thing that the shorts used to do to the producers. So there you have it. Not a lot of insight to give here, but I don't think a lot has to be given. We know that's actually another good insight. Yeah. So back to this. Just factually speaking, that's a big number. And when you look at it in combination, the bullion banks bought 23,000 contracts. Some bought strength, some bought dips, but all they're doing is buying. So here's your conspiracy. Scott's comment, which it's not really a conspiracy. These guys talk to each other. They're not different banks. Some of them are different banks. Some of them are same desk, different parts of the bank, right? These guys have the buy order. These guys say, well, I'm going to buy too. And that's it. You end up having, in aggregate, 23,000 buyers. So we don't see it until afterwards. Wouldn't it be funny if 2 years from now, we all know each other, we're doing this, and the COMEX shuts down because all the funds are blowing out, getting short? It feels like we're in that process of rotating into that, where the funds are playing short and the banks are playing long, kind of like what happened in Palladium in the O's. Anyway, just a comment. Nothing too insightful about that. Next chart. Let's see the options. All right. Market rallied. The long funds sold all their calls out. Okay. Long managed money didn't sell their calls out. Not much anyway. They actually got longer. The short swap dealers, nothing substantive. The long swap dealers sold a little bit out. These guys, do they match up again? Wow, look at this. Look at this. The buyers of calls and gamma in the rally. Well, here we go. That's this. Here's a $5,000 swing. They got shorter $5,000 from gamma, and they got longer $4,000 from gamma. Okay, so these guys cancel each other out again. So everything shows options weren't significant this week. Did I miss any? Oh shit! Look at this. Look at this. They weren't selling futures because they were bearish, guys. They were selling futures because they were covering calls. How's that? The short funds are getting killed. Again, the macro long funds didn't do much with their options, probably hedged gamma. The managed money shorts didn't do much. Managed money longs sold a lot of their calls. And the banks, not much to call about. So the managed money longs sold their calls, and who bought them? These guys. Right? So managed money longs sold their gamma in the rally to short covering other reportables. And that's it. That's the story. Wish I could make it more interesting, but I can't. Right? Reading Leon's note here. Remember with COMEX or any futures exchange, they make the rules and they will. Yeah, exactly. Jim, did you want to show me that picture? Do you have it handy?
Yeah, it's in the notes.
Oh, I missed it. Hold on.
That's all right. I sent it to everybody, but
So let's see it. Okay.
So what I'm seeing is the RSI will get overbought, but at the end of the month, that's when they sell. There's a little bit of a sell-off here the second week of March, but
Wait, are we here or here? Where are you talking?
well, I'm starting at the beginning of February. There you go. So
Okay,
you
so
can see that's the end of the month. There had been some stair stepping where it was down a couple days during the week, and now it
right.
looks like it's shifting to more towards a weekly stair step down before they go back up again. But the weirdness starts because we had that spike during the last, what was that, April 22nd.
Okay.
That's when everything got kind of crazy and went up. So I don't really know what to make of this. I'm projecting if they continue to do what they've done, this coming week should be another down week. But honestly, I don't know. I mean,
Right.
but you can see February 24th. You can see on March 31st, and then we've got what happened this last week.
Yeah. Well, these are Bollinger Bands you have, right?
Yeah, those are Bollinger Bands. I've got the regression, linear regression in red, and then I
Yeah.
got some noise I just threw in
All
there
right,
for
so the
myself.
Bollinger Band. So this is coinciding with a peak here.
Yep.
Right. This is not coinciding with a peak.
No.
This is not. That's not one. This is coinciding. That's not.
We're a week early on this last one is what it
Right.
looks like. And that's probably because things got out of control. They went up so fast.
Right. Right. Okay. Uh
2 months is not a pattern, but I think we may be seeing a pattern evolving is what I think is going to happen here. I could
yeah,
be
yeah.
wrong. I
This
don't know.
is this is a daily chart over a 2-week time frame. Is that what you're
This
looking at here?
is daily starting, well, it goes back about 3 months, but that's what I clipped is like the last 2 months.
Right. Right. See these indicators down here? They might be more helpful to you if you go to intraday chart.
Okay.
You might need to get a little more granular to see if this
Okay.
pattern is random or not. Anyway, certainly something to look at. Thank you.
Yep.
All right, so Randy, let's move to your stuff here. Right?
Vin, could I just say one thing on the options before?
Yeah, Scott.
Yeah, it looks to me like I think the funds have done quite well on the shorts. Yeah, then I don't think
no,
they
they haven't lost money. Wait, hold on. Which shorts? These guys?
Yeah, I don't think they're getting killed.
Well, the options they are. Sure they are.
Well, if it's on the short side and they're less short, they must have been long puts, right? Which have lost delta through the rally. And then they've sold futures to make. So they've gone from being less aggressive to more aggressive. And then they nailed it, right? Because it came off.
Okay, so I think the fundamental difference is they made money or lost money depends on if they're playing the delta game or they're playing the vol game. Is that what you're getting at?
No, I'm just assuming that for their short to have got down in option space,
right?
They had to be short on that side. They have to be long puts, right, or short calls. If they're short calls, they'd be shorter. So they had to be long puts, right?
No. Okay. No, what I'm saying is yes, that's right. Right? If the market rallies and they're getting longer, they're moving away from long puts. Right? Less short, I should say. That's what you're saying, right?
Or they're losing the short exposure they wanted, put it that way.
You're totally right. But I want to refine this. I have an assumption that I've said before, but probably needs to be restated. All right. In gold, it's a call denominated market. So the funds buy calls, and the people who want to go against them sell calls or buy puts. Okay? All right. Now, not always. It's kind of like everyone talks about calls. Nobody even understands how put works. It's stupid, but it's true. Now, that background aside, not factored in aside, if the market rallies and these guys are getting less short, Well, that could be because they're really, really long puts hedged. And when the market rallies, they're selling futures. Remember, they sold futures here. They sold futures here, Scott. Right? So why did they sell futures? Well, they could have sold futures because they're long puts. Market rallied, right? They have all these extra deltas. They sell them back out. So I come in flat on the week. It's like a straddle, right? I'm long a put. I delted out my put. The market rallies. I kick out my futures again. Or staying with puts. Or I'm long puts. I'm long puts, and I'm long puts, and the market rallied, and it ate me up. Right? Meaning I sold futures. I'm already long puts. The market rallies, and the options stopped out my shorts. You follow that part too?
No, I don't follow the second part, that you
Okay,
would
right.
stop that in shorts.
The second one is kind of like using the put, using.
So the way I would look at it, okay, let's say that that's a fund in other reportables and not an option market maker.
Right,
but let's
right.
say it's a fund, he's going, these moves are getting ridiculous. They're big.
Right.
I'm going to buy some puts.
Right.
And then by the end of the week, he goes, those puts aren't worth anything, but I'm really even more convinced this thing's going to sell off. I'll now sell some futures. That's how I read that column.
No, I agree. I agree. It's so there's if you use puts, if they're long puts, see, I start from the assumption that it's not puts, and I'll explain why in a second. Even though mathematically, statistically, it could be either. And forgetting about my bias, it's puts. I mean, it's calls, but let's say that it's puts.
But then it has to be short calls, right? You can either, in the short column, you can either be long puts or short calls to get a negative delta there.
Let me finish on your put thing first.
Sorry, go ahead.
Because we may have an accord a different way. You know what I mean? There may be a piece that we're both missing. All right. So if it's puts and the market rallies, they could be long puts. The market rallied and they said, shit, I still want to be short. This is a variation of what you're saying. And so they kick out their futures on the last day. That's a day where they lose a little bit of money because all their puts are going out worthless and they kick them out again, right? They kick out futures or they buy puts, right? With no calls here, right? The second one is they're long puts. The market rallies and they puke them. Not easy to measure, all right? So these two examples are predicated, and any other example you come up with is predicated on someone who's long puts and uses those to express a bearish opinion. So either they're losing a little bit of money or they're losing a lot of money, right? I'm long 50 delta puts, the market rallies, I get screwed. I'm long 10 delta puts, the market rallies, I kick out more futures. I don't think they're making money. Now, I could be missing something. That's why I'm saying all this to you, right? Now we go to calls. Why is it calls? Because options players on the call side, on the bull side, do not play short puts. They're not allowed to. They're not allowed to, right? For the most part, right? So here we go. Once you find this, and I'm agreeing with you, let's say we don't know if it's calls or puts, okay? We don't know. But then you find this, and I know this is calls being sold. I know it because they're long calls. And if they have positive gamma and the market finishes higher, how do their longs decrease? How do their peeling off longs How do their longs decrease if the market rallies and they have positive gamma? I know, as much as I can know anything, they're long calls. Are they short puts? Maybe, but they're long calls. They're long call spreads, long calls, long call versus short put spread.
Yeah,
whatever.
So that column, they dumped a few futures, but they dumped even more calls.
Yeah. So watch.
Yeah.
Here's how it works, OTC. For those that don't know, somebody calls up and says, I want to market in this call. They don't just sell the call. They couple the call with the futures. So of this 10,700 lots, 2,000 is hedged gamma, and the rest is paired up with options. Or they bought futures when they sold their calls. See, they sold 10,700 deltas, but they only sold 2,000 futures. 8,000 of their deltas or gamma deltas was sold using options. Now, if I'm right about this, and I'm pretty sure I'm right about this, and this is longs selling calls, otherwise they would be longer, and there's no one else with a big change. Look, here's 8,000, right? What is this? 1,200? What did they do? They bought calls, right? I'm sorry, they sold calls. They sold calls too. Wait, market had shorter, reduce their shorts less. Yeah, so they sold calls. So sold or have negative gamma. The point is, this is the big one, right? Find me another big one. These guys match up. Again, these guys reduce as well. So watch. 8,500 to 6,900, that's 1,600. That's calls. Could be calls, not definitely calls. Could be calls. This is definitely calls. That's 8,000. So 9,000, right? 10,000. And look at this. You follow? That's why I say the shorts are short calls, not long puts in this instance.
Yeah.
So, am I wrong?
Yeah. No, I see what you're saying. It's just, I don't think from an accounting perspective it can show up there. I think it has to show up in spreading, what you're saying. But
You mean the OTC?
anyway, no, you've got the spreading category in both options and which to me is the delta bit, right?
Yeah. I hear what you're saying. Yeah. Let me think about that.
Anyway, this is getting esoteric. I'm gonna.
No. Well, exactly. We're gonna stop now.
You'll accuse me of boring everyone again, so I'll stop.
Right. Well, where we differ right now is I'm quite convinced that the option guys on the fund side are short calls and covered into the managed money selling, just like the shorts covered in futures into the managed money. Okay, watch. Shorts covered, longs sold. Shorts covered, longs sold. All right. So where we differ is I think that the other reportables are long, short calls. You think they're long puts. So we'll see. I'm not sure about that, but I see what you're saying. And the problem is when you take these in combination, this change informs you of something else going on in options.
Yeah, I remember we've had this conversation. Yeah, the problem is you want to look at futures on its own. And then when you look at futures and options, you're tempted to consider that some of the futures positions are actually not outright futures positions, but they're a hedge against something else in option world.
Yeah.
It's not clear, and it's not clear in this commitment of traders documentation how that gets accounted for, whether it's in spreading or what have you.
No, I get it. I'm looking at. I get it. I understand. I understand. So, all right, let's drop it for now. But we should have that conversation another time. All right. So that's it. I'm done with that. There's really not a lot of great insight here, except to say I think there's really a good insight to come of this. That is the banks have gone from being stupid and losing money with a small contingent of long players making money to the long players being smart and the shorts watching the long players to cover their risk. That's my comment. All right, Randy, let's do a run through of your stuff, and then I'm going to go.
Okay.
Let's do the open interest first, right? Easiest place to start.
Sure. Get over there. Nobody is participating. That's. I texted you that earlier.
Yeah, I remember you.
And here we are down at 454,000.
Yeah.
And we're just barely a couple percent off the high, right?
Yeah.
you know, where are the players? Are they just running for cover because this is like, you know, I guess maybe Scott's, I think I heard Scott say, you know, things got really crazy here the last 2 weeks, and they're just, you know, is this just too much risk for them to play?
Well, I mean, look, just what you're saying, what Scott's saying, and what I've said are all different ways of seeing the same thing, and that is observably from here to here, or more obviously from here to here versus from here to here. That's a short covering rally. That's what it is. That's shorts covering into strength and long selling. So, to your point, Randy, to Randy's point, and my point, macro discretionary is selling into strength, but they're not returning. They don't seem to be buying the dip like they used to, like they were for the last year. And certainly the CTAs are not buying. It's like, you know, we take profits, we puke, we get back in. Well, you took profits, the market rallied, right? You sold. Come on, man. I can't keep doing this shit. I can't keep letting people in at fucking 3 o'clock. You know, trying to get this done. Anyway, so there you have open interest dropping, and you have the market telling you they should be adding at some point, and they're not really adding. What they added here, that's this. That's ridiculous. So, nuance aside, shorts covering, longs getting out, markets going up. That's a fact. That's what that is. So, what to the question, the existential question that Randy's asking is, what's going on? Are people in the short and intermediate term saying there's too much risk? I don't want to play around. Could be. Probably is. Some of them are going, oh, Basel III is coming. This is coming. That's coming. I don't want to fuck around with it. Some are taking profits and putting their money somewhere else. Maybe Bitcoin. We saw that before, right? Maybe oil. We haven't seen that yet, right? So I'm talking about the macro discretionary guys, the fun guys. Some of the fun guys are saying, and I mean this, some of the fun guys are saying, I don't want to be involved in this market if there's no liquidity. If the market, you know, maybe they're selling it to strength, just getting out. There's still some length in there, but not much. And then there's the other thing.
Good.
Take profits and reassess, and now you're looking at kind of a combination of what Scott's seeing, or what he's thinking, and that is the bullion banks are getting out because there's physical demand all the way up now. This behavior, okay, right? What are some of the assumptions that I've had over the past 2 years? Physical. Central bank buying doesn't chase. That's what I would say. Central bank buying doesn't chase. They have a level, they pick it, they're done. Well, how does central bank buying chase? How does physical buying chase? They ratchet up slowly. I've said that before. But this behavior, by the way, guys, this behavior of the more aggressive short covering coincides with China insurers buying, meaning the announcement of them buying. Okay? So it's quite possible that while central bank isn't chasing, central banks don't chase. Central banks go, I'll buy it here. And then when it goes up here, they'll say, I'll buy it. This is central. But I'm making this up. But central bank buying is patient. They don't chase. Patient. They don't chase. However, insurance buying is based on revenues. They start marketing product, and it's like, I've got 500,000 people that want to do this. They put it in order to buy the gold. Okay? And if they don't get it, let's say if gold's trading here, they make 20% on their product. If gold's trading here, they trade 25% on it. They're like traders. As the market drops, they go, oh, let some of my profits run, right? But they put their order in as the market runs away from them. The bullion bank longs are chasing, making them chase higher. So it's almost like the bullion bank longs are forcing the bullion bank shorts to also buy. And the insurance companies are the reason that it's happening. So my very early comment is that this all started happening, tying together Randy, Scott, me, and everyone else who thinks this way. This all started happening right around the same time the insurance companies started coming out of the box and being told they can buy and would buy. When that happened, Shanghai premium went up again. When that happened, short covering started happening in the U.S. More aggressively. When that happened, funds started selling. I don't know why, but they're taking profits. And when that happened, somebody in April tried to spoof gold on a physical delivery. So I believe putting what everyone said together, early comment, physical demand is ratcheting up more aggressively. That's the only thing that makes sense now.
Yeah.
Right?
So if this
ahead,
is a
Scott.
physical market and you're a bank and you want to move to a physical market, you need to get rid of everything which isn't physical because you don't know what it is.
Right.
Right? You want to deal in smaller size in physical. But then you got these 200,000 contracts you're short, which the funds are.
Right.
And you used to be able to get them out of them by banging the market lower.
Right.
How do you get them out now? It has to go higher, right?
That's true. That's true. And by the way,
to go higher.
By the way, if I'm a big fan of a macro, so we know why in our little working theory here, why the banks are covering and why they're buying. The physical demand is ratcheting up, it's coming, and so the bullion banks are covering their shorts more aggressively, and the bullion bank long desks, who probably have the fucking buying, are kind of telling them, hey, we're buying too, maybe you want to cover, right? The question is, and this you might have been touched on, is why are the macro discretionary guys not rebuying? And the answer is the macro discretionary guys are not rebuying because come Basel III, they need to have more money to trade physical in futures. Futures they won't be able to use as much leverage as they used to use. So therefore, it's quite possible that the COMEX is turning into a spot market. There you go.
And if you got 1 minute, take a look at the live spreadsheet tab 10. And, everybody can make an opinion here, but this kind of correlates what's going on. 10 is the commercial long and shorts, right? So it's the red and the green lines we always look at.
I shrunk my screen too much.
Yeah. Right. So
which one?
January 1st is kind of where the shorts peaked. This is commercial shorts, the red line up there. They peaked up there, and that's when gold in the lower chart or to the right, either one, blasted off January 1st. They've been covering shorts, but their long futures, the green line, it's not increasing. So what's pushing the price up? Physical delivery?
Well, no, it's short covering, and the short covering on paper is pushing the price up from the physical demand.
Right. Yeah.
Somebody tried to take delivery on COMEX. There's your example. But here's what you're saying demonstratively. I think this is what you're saying demonstratively. Just this area is where the shorts on the commercial side peaked, and they've been going down since then.
Yep.
Steadily. And this is also, where is that?
So the scales aren't the same. So January 1st is there, right? Yep, that's at the bottom right there.
And this is the market going up. So this coincides with probably right here.
Yep.
There's your break point. Right here. Right? And in here, I'm not fucking around, in here, we had someone trying to take delivery. I stand by it. So when I say, a little bit hyperbolic, when I say COMEX is going to die, and I mean that, it's a risk. What is happening is physical demand is overwhelming futures play. So we've seen this happening for a while, but maybe the insurance guys are pushing it to another level. So,
if you want to take a look at real quick, tab 11 is the non-commercials, same setup, and significant shifts here going on. Again, for guys who may have not seen this before, this is weekly data. It's on a separate page, but the numbers kind of show up the way they are.
Right.
It's hard to miss what's happening here.
Right. So the market is rallying. It's not showing now. There it is.
I don't have that below.
No, I'm talking about myself. The market is rallying, right? And wait, I lost my I cut off your dates. All right. So what did we say? We said the open interest started dropping in January, right?
Correct.
For the commercials. So. Oh, fuck, I have to shrink this a little bit. It's not all fitting. Hold on.
The bottom line is the non-commercial, as you deduced just by looking at the other numbers, the non-commercials longs are not playing.
Right. They're not buying the dip. They're not
No.
getting back in.
No.
It's like they're exiting the whole thing. All right, so where we are, we are March. Does this look like March 1st to you? Right around here?
Yeah.
Wait. March 25th. All right, you see
It's
this
just
here?
because there's so much data in there that Google spreadsheets
But here,
compresses it.
see, here's March 25th, right? Does March 25th line up with here or in the middle of your date?
Yeah,
Do you know like how these line up?
Yeah. March 25th is like where the little red line just barely breaks over the blue reference line. Yeah, right there.
Okay, so here's a straight line. So it's right where the 25 is.
And that's that little pop-up that somebody tried to take delivery on. That's
right.
Reason that's what that shows.
Yeah. Right. So March 25th, March 27th was first notice day, and and that stopped. And then the market ran up, and then it came off. All right, so we got the.
Good.
So here's the long. Here's all right. So let's go back to the schedule here. This run up. Here's a dip in the. Here's the market. The yellow line. Dip, run up. Okay. Non-commercials sold weakness and sold strength. Right? Getting out. Long non-commercials, getting out. Market rallies. Non-commercials. Long non-commercials. Sold strength. Sold sideways. Bought strength. All right. So there's definitely an exodus of futures players on both sides. And it's kind of matching up. Anyway, I'm really having a hard time breathing here, so I'm going to go. All right. So this has been very good. I think we have some new. Good. What?
No, just saying thank you. Sorry to talk over you.
That's right. No, thank you. So what are we looking at here? We're looking at real evidence. Two things that are jumping out now. Evolutionarily speaking, at the first level, we're pretty sure that the bank shorts are covering into strength. They're also buying dips. They're just buying. And it makes sense behaviorally when you buy the dip and then you drive it up. That makes sense. I'm not backing off from that. But the percentage of non-commercial, not non-commercial, the percentage of commercial longs versus commercial shorts is changing substantially. At least
and decreasing. It's decreasing. Just a straight ratio of the two is decreasing.
It's becoming like 50-50. It's going to become 50-50. They're going to be well balanced. Something like that. Yeah. Thanks, Braden. So that's the first point is the ascent of the commercial of the swap dealing longs versus the swap dealing shorts, as Scott pointed out. The second thing is the only thing aside from the death of COMEX tomorrow, it's apparent that the macro discretionary longs are booking profits and really not returning with a vengeance. They're not buying dips like they used to. Who's buying the dips? The banks are. Is it the shorts buying the dips? Maybe, but now it looks like the long-sided commercial swap dealers, the banks, are buying dips. Why? Throwing in what Scott was talking about here. Well, they're probably front-running the buys that they have underneath. So who the fuck will be physically buying gold underneath doing this? If we know macro discretionary is not chasing, It's Paul Tudor Jones that's here, and the bank swap dealers are front running him. No, they're front running bigger order flow. Is it central bank order flow? Could be. Could also be that insurance flow or flow tied to the insurance flow. Anyway, long story short, the market has turned from futures with physical to physical with futures. And the longer term macro discretionary hedge funds are taking profits and not coming back increasingly not coming back. That's the first trend.
Can I just add one thing to that?
Yeah.
As well. I mean, it depends where these guys have been long for, but they've been long for a while.
Yeah.
So their notional exposure is probably twice the size it was when they put the trade on in percentage term of and also the vol's probably 2x now as well.
Yeah, that's true.
So the risk of the position. So it's a much bigger position for them than it was before.
That's true. I mean, the macro discretionary guys are definitely not all the macro discretionary guys are selling and not returning. Some of them are just really long for maybe a year now. Who knows? So some of them are just getting out. And that's quite possible. And at least partially true. There's no doubt about that. But overall, they're not getting back in. Like some of them are not going to get back in until it drops $5,000. You know, that type of big picture mentality and risk as you're describing. Some of them are going to get back in. We're not even really seeing the regular size funds get back in. We're not really seeing a lot of that at all. Maybe they're lost in the shuffle because the volumes are so big now, but we're not seeing it. And because we're not seeing it, the buying is being dominated by the banks. The banks are buying. Shorts are covering and longs are adding. And they're all buying ahead of physical buying being right underneath them. And that's what's different. There's physical buying that's ratcheting up at a faster rate than we've seen before. And it could be because we're going into Basel III, although I don't think it is. It could be because the insurance companies are actually in the market now. And by the way, the insurance companies are in the market now. The Shanghai premium went up and gold prices are going up again. That's the evidentiary stuff. Okay, so that's it. Thank you. I just wanted to get all that done. Stop recording.